This handout just is an overview of the tools that the Federal Reserve has at its disposal for monetary policy. And once again, monetary policy is the Federal Reserve's controlling of the money supply. And in the money unit, you looked at the reserve requirement and calculated that, and we did some work with that. So that is one of the tools that the Federal Reserve has at its disposal to deal with if there's too much money in circulation or not enough money in circulation. And so when we say tight monetary policy, that means we are pulling in money. We've got too much money out in circulation and we're having some issues with inflation and things like that. So we want to tighten up that monetary policy and try and get some of the money out of circulation. When we have easy money monetary policy or easing of monetary policy, that's when we're trying to get more money out in circulation. So the three tools they have are interest rates. They control the interest rates. The reserve requirement. I'll put that down there. Reserve requirement. And then the last thing that they can deal with is the buying and selling of bonds. So if we want to tighten that up and we want to get money out of circulation, one of the things that we can do is to increase our interest rates. When we increase interest rates, and we've been talking about this since the very, very beginning, when interest rates are high, people tend to not spend money because borrowing money, the opportunity cost of borrowing money becomes much higher because you have to pay back more money. So if we're trying to get money out of circulation, we increase interest rates, which gives people more of an incentive to save and less incentive to borrow because borrowing money tends to be expensive. The reserve requirement, we did that. When we want to get more money out of circulation and we want people to quit spending so much, we're going to increase that reserve requirement. Remember, that's the amount that the banks have to keep in reserve, then they get to loan the rest out. So if we're seeing inflation, instead of having a 10% reserve requirement, they might make it 15%. Banks would keep 15% instead of 10%, and then they would loan out the rest, which would pull in and not allow us to increase the money supply by so much. And then the final one, bonds, we would sell bonds. Remember, the goal is to get the money out of circulation, and so the Fed will get the money, and then the people would have the bonds. So that's one of the things they would do, some sort of campaign to make it, to incentivize people to buy some bonds. Easing monetary policy, it's the exact opposite. If we want people to start spending money because we are in recession, we're going to lower the interest rates, make it a little more attractive to borrow money and not so attractive to save money. We will lower the reserve requirement, telling the banks instead of keeping 10% in reserve, keep 5% or 1%, depending on how bad it is, to get more money pumped into the economy. And then they would buy back bonds. They would have some sort of campaign that would give people an incentive to sell their bonds back to them. So they would buy bonds, and when they buy the bond, they have to take the bond out, and now people have the money in their hands, and hopefully the purpose of that is to go ahead and spend that. On this same handout, fiscal policy, I'm just going to say it on the video. Fiscal policy is the government tools on taxing and spending. All right, so same situation. What happens to the amount of money that I have in my wallet if the government taxes or increases my taxes? So if they want to tighten that up and get some money out of circulation, they're going to, and this is fiscal policy. These tools up here are monetary policy. When the government uses taxing and spending, that is fiscal policy. So in times of inflation, where we have to tighten that up and get some of the money out, they're going to increase taxes and they're going to decrease their spending. And the opposite during times of recession. They're going to lower your taxes so we get to keep more money in our pocket, and then we're going to increase the spending, getting more money out in circulation.